If you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6-1, what more do you need to know? And that would be my biggest piece of advice.
Not that I don't remember. It has never happened before that you had a triumvirate of bubbles in stocks, bonds, and equities. But bubbles are, they can exist for a long time, but then they always burst and they always mean revert. But this time you have to mean revert home prices, equity prices, and bond prices.
We suspect it will be used this quarter and quite probably in the next few weeks. Once you break it, we declare we're in a major bear trend.
In today's episode, 3 financial experts, Andy Schectman, Michael Pento, and Michael Oliver, share their insights on the current precious metals markets. We watched hours of footage to bring you the best clips of the week. Schectman discusses why now is the time for retired investors to take profits in equities and shift into gold and silver, given their promising outlook. Pento delves into the looming bubbles in equities, bonds, and real estate, sharing his strategy to short the markets in 2025. Meanwhile, Oliver provides his technical analysis, revealing key momentum trends that could signal seismic shifts in the financial landscape. Don't forget to like, subscribe, and turn on notifications so you never miss our recaps. And if you're a stacker, check out our special deal with NordVPN, the fastest and most reliable VPN on the market. Protect your online activity when browsing investment-related information and ensure your privacy from prying eyes and government surveillance. With our link in the description, you'll get an additional 3 months free. Believe me, it's a game changer. Lastly, if you want to learn how to stack like a pro without relying on market commentators, check out our Stacker's Handbook at goldsilverstacks.com. Enjoy the episode.
I'd like to mention, too, in my interview with Judy Shelton, I asked her some tough questions. And I said, what about the gold not being audited? And she says they always come up with these stupid excuses, too expensive and logistically challenging. And she's like, that's hogwash. We're the United States, spend a few $1 million and get it audited. And that's what she would advise. And I asked her about revaluing gold, how Cynthia Loomis, she said she's a big fan of Cynthia Loomis, Senator Loomis from Wyoming, and an advocate for what she's talking about, revaluing gold. She didn't go out and fully say it, but she more or less said, yes, that is a strong possibility, and that they would issue, she believes, on July 4th, 2026, which is the 250-year anniversary, they will issue, Trump will issue 50-year treasuries pegged to gold. And then she said something very interesting as well. She said, and then I could see stable coins being issued backed by the 50-year treasury collared with gold. And this is a woman who could very well be in the Federal Reserve. She was an advisor to Trump. He wanted her to be the head of the Fed. She's very smart. And I think the bottom line is that when I look at everything I see all this talk of crypto and profit and greed and risk on, and the central banks are doubling down on their gold acquisition. Hand over fist. And 45 million ounces of silver delivered off of COMEX, either through flat out delivery or exchange for physical in the month of December. Who's got that bread? Where's it going? So we're getting to a point where I think these countries, and they're going out of their way to hide it. Saudi Arabia got busted for not reporting it to the IMF. Sorry, we made a mistake. Well, the import-export numbers outed them. Same thing with China. A recent article just came out in Reuters the other day saying that they think that the numbers they've been buying are 10 times understated. 10 times. And that they have never stopped buying all along when they said they took those few months up. No, they didn't. They just were hiding it and buying it directly from the miners or buying it through the People's Liberation Army. So you see a concerted effort to hide the de-dollarization and to mask it. And after what the BIS did to the BRICS nations at the 12th hour by pulling out of Enbridge, saying we can't work with a country being sanctioned, forgetting that Russia was the R in BRICS, after 4 years of working with these countries to develop it, I don't blame them for being less than forthright. But the one thing that I see through all of this is that the central banks keep buying gold and possessing it, repatriating it. And when I hear someone like Judy Shelton say that's in our future, then I would simply say, especially for those retirees, if you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6-1, what more do you need to know? And that would be my biggest piece of advice. And everyone is so infatuated with risk on. That's the exact time. If you were having a beer with Rick Rule right now, he'd say that's the exact time to move the other direction. And that's what a contrarian does. So one of these times, this broken clock of ours will be right. And even though gold was up 30% this year, it feels like it didn't do anything, right? Because we live in this instant gratification, triple your money in 3-week environment. That's going to hurt a lot of people because that's what they believe investing is. And my whole career, 35 years, says, no, that isn't what investing is. And no, this isn't different this time. I think there's just a lot to be cautious about, truly do.
In the continuation of the episode, Michael Pento highlights the massive bubbles in equities, bonds, and real estate, outlining his strategy to short these markets as they face an inevitable correction in 2025.
They just, go to like the shadow banking system and say, hey, here's some debt, finance it at a very low interest rate, and you can't get out of it. You don't price these. There's no pricing mechanisms for these bonds. It's private. So that means you're locked in. There's no liquidity. I mean, this is a big problem that we have once the recession hits, and there will be another recession. The yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10-year note. So I don't throw out my theory that we're in for a lot of trouble. I invest money for clients. We had a positive return in 2024. So it's not like I'm sitting here shorting the market. I'm just warning people. I'm not a Cassandra. I'm just warning people that this is the most dangerous market ever. Look at valuations, have never been this extreme. If you look at things like price to sales or total market cap of equities to GDP, or if you look at earnings yields, so the risk premium, earnings yields minus treasuries, it's zero, if not negative. So what I'm doing right now is I'm only slightly long the market. I have a slightly net long position of about 15% long the market with hedges in the portfolio. I have a tremendous amount of bonds on the short end of the yield curve. I think whatever's left in this bull market is not really worth the risk of being overly long in this. First of all, if you were in the 60-40 portfolio, think about 2022. So 60% stocks, 40% bonds. And that, by the way, that reverses as you get older, where you could have, say, 30% stocks and 70% bonds. If you look at long duration bonds, they are down 50% since 2020, 50. So your return on a bond fund that's out along the yield curve, you've lost half of your money, not in Bitcoin, not in Fartcoin, not in some pink sheet stock that doesn't trade. In U.S. Treasury bonds, you lost half of the value. So I think 2025 could look a lot like 2022 when you see these bubbles burst. For the timing, I rely on my model that I created. It's not time yet. It's not going to happen, on Friday, I don't think. But it's definitely something that's going to happen soon. And when it happens, it could bring down both bonds and equities concurrently. Along with real estate, it could be very, very dangerous for the 60-40 buy and hold portfolio. So I would maintain an extreme flexibility and have a robust model, an algorithm that lets you know when to get out of harm's way, when to go into short-term treasuries, when to go into cash, when to go into the dollar, which, by the way, the dollar's been working spectacularly if you're long the dollar. So that even could get even worse. As far as the appreciation of the dollar, and you must be able to short the market adroitly.
In today's news recap, gold demand in India slows, Lunar New Year fuels interest in other hubs. Gold discounts in India rose this week as consumers refrained from buying as local prices hit a month's high, whereas the upcoming Lunar New Year festival stimulated gold buying activity in other major Asian markets. Indian dealers offered a discount of up to $17 an ounce to official domestic prices, inclusive of 6% import and 3% sales levies, up from the last week's discount of $14 an ounce. Prices are high, so buyers are holding off on purchases. Anyway, the inauspicious Car Mass month in Hindu calendar is still going on, an Ahmedabad-based jeweler said. Jewelers were on the sidelines due to volatility in the Indian rupee and overseas gold prices, said a Mumbai-based bullion dealer with a private bank. International spot gold prices hit 4-week highs this week. In China, the world's top gold consumer, dealers quoted discounts of $2 per ounce to $9 premium on spot rates, down from the premiums of $4.50 to $10 charged last week. The year of the snake approaches, arguably an auspicious year and a perfect backdrop for further gold purchases. Independent analyst Ross Norman said Chinese investors will be encouraged by news that the PBOC have added gold to its reserves for the second month in a row, which may suggest the current price reflects fair value. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your gold and silver gear, from t-shirts to hats, designed by stackers for stackers, premium quality, shipping worldwide. Let us know if you'd like any specific designs, and remember, mine is bigger than yours. Let's get back into the episode.
Well, we've had what we call, people like to talk about prior stock market bubbles. The 2007 high was a bubble. It was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932, wiped the thing off the page almost, percent-wise. It took decades to get back to it. So those are things people call bubbles, but this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see, even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically. It's the most essential commodity, because when I buy from Mr. A to buy a product and he gets the money and I get the product, he wants to be sure that what I give him is actually got a whole value between now and next year, and so forth. And if it's changing in value, because of the quantity of money increasing drastically. In the last 15 years, we've had more money growth than we've had in any other 15-year period, percent-wise, decay in the real value of the money. And then we've had artificially low rates. So that creates errors, individual micro errors, family errors, corporate errors, and they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busted. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, whoa, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug-infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000.com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. Nasdaq went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50% in S&P. They cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started. Once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here. And desperation and moves by central banks to buoy their assets they deem worth buoying, like the stock market. The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Because once that blood starts to come out of that market, it goes somewhere else. Anytime the stock market collapses, the asset flow doesn't disappear. It actually seeks other places. Usually that's T-bonds and gold. This time around, it's going to be primarily gold and related markets. And it's the breakage of the stock market that is the key pending impetus for gold.
Do you agree with Schectman, Pento, and Oliver, or do you think the markets will continue to boom in 2025? Are you still stacking gold and silver, or are you waiting for a big dip to buy more? Share your strategy with the stackers in the community in the comment section below. We'd love to hear your thoughts. And don't forget to check out goldsilvermerch.com to grab your gear and represent your passion for precious metals. Thanks for watching. And now check this video right here because you'll love it. I'll see you on the other side.